We can start now. Perfect. All right. Okay. Welcome to one of the esteemed webinars for FX Street. What we will be covering today is a topic for on volatility, a key topic on market behavior, price action. It's volatility, and at the end of the session, or the goal actually of the presentation is to present my work, my advanced work, an indicator called volatility valuation and what it can do. But before going to that point, what I would like to do is create the building blocks. So give a bit of background information of the volatility in general, so it won't seem out of the blue. So first of all, let's begin with the usual risk warnings that trading, of course, especially with leveraged investments, can involve significant risks, and there is only one guarantee in trading, and that guarantee is that there will be losses, and that guarantee I can give you 100%. Now, so obviously, what we will be trying to do is have more profits than losses. So before beginning the presentation, let's show where we are in the big picture, which is, what I like to call it context before content. So let me present where volatility comes in the grand scheme of things. And the grand scheme of things, by that, I mean the smart strategy system, which is what it's a set step-by-step checklist or a learning path, if you will, of how people can either, when they're beginning, learn trading, or if they're already advanced, they can use it as a checklist to organize disparate information such as fundamentals and technicals, and how you can create, how you can combine these into a coherent structure, so you can create strategies, and that's the strategy system. So most people without this kind of a learning path or a roadmap are usually scattered. They go from one technique to the next. They are don't have a rules-based approach. So our goal is how to go from scattered to systematic. And this is the roadmap we will be creating. So the first thing they have to do is, how do you combine technicals and macros? The first thing is we have to look at the macros. I always start with the macros, because the macros are the why, and that's very important. Secondly, I proceed to the technicals, actually the markets themselves, not the background information. And technicals, for me, always answer the when. So one is the why and one is the when. And if you combine these into a trading strategy, the strategy, of course, is the how. How do we actually trade? How do we actually get into position? So let's see what are the components of this, and then we'll see where volatility comes into it. So let's see about the technicals. This is what I call an MTMF approach: multiple time frames, multiple factors. And I call this because I use 3 different time frames. The time frames I use is the monthly, the weekly, and the daily. And I call it also multiple factor because I use different factors to judge or see if a market is bullish or bearish. So let's look. I always start with the monthly chart, which on that I check out the business cycle. Of course, it's not the point of the presentation to go into this, but what I will be doing, in case you get a very high level how it works. Secondly, I go into the commitment of traders report, which is very, very, very extremely important to me. And it shows the open interest, how much the big players, the big boys are holding in positions. Then I look at sentiment and seasonality, which are, all these factors are very important, especially seasonality and market sentiment, because sentiment is, of course, is a measure of liquidity. Then I go into the technicals. And the technicals, well, I look at the trend roadmap, basically the trend of the market on all its 3 long, short, and intermediate term. Then I look at the MACD momentum model, which it's an indicator created in 2015, and it was awarded 2022 with 2 international awards, the Charles Dow Award from the CMTA, the Chartered Market Technicians Association, and the Founders Award by the National Association of Active Investment Managers. It's quite a bit of unique work. I've already presented this on FX Street, but I will also be doing follow-up, more advanced seminars on that. And then I look at valuation. This is exactly what we will be talking about today, volatility. So, and then relative ranker, which is basically the way to see which market is stronger. So again, I'm talking about very high level. And how do you construct a strategy? Because these are the components I will be using to see if a market is bullish or bearish, or when I want to be buying or selling. And so how do we create a strategy? A strategy has 4 core components. The first thing is the setup, basically the why, if you want to be going long or short, which means that the previous 8 components, I take them into a setup. Then I have a signal where I actually physically get in, because the setup is the factors that will tell you if you're going to be long, short, or out. Basically, if you're neutral, if you don't have a clear view. And but the signal is when you actually physically get in, because if you're bullish in the market, it doesn't mean that I'm actually automatically buy. And then I'll look at the size and the stops. So have a stop loss. Actually, there are 4 types of stops, and then also position sizing. So this is the smart strategies roadmap, and each and every one of these has its own template, checklist, or rule book, if you will, rules based. So let's talk a bit about volatility valuation here, highlighted in red, because it's very important. It's one of the what I call first principles. So volatility valuation, volatility. What will be breaking down the presentation in 3 parts. First one is theory, cover a bit, just very, very, very slightly. Then we'll go into the tools and then the techniques. So theory. So just very briefly, this is a chart. I didn't create this, I found this on the internet, but I think it depicts very well what volatility is. So if you have, for example, 2 stocks, one depicted in blue and the other one depicted in red, and theoretically they both reach the same price, $10, but there are different paths to it. As you can see, the one has bigger oscillations than the one in black, so which means it's more volatile. And it has a lot of implications, volatility, because if you've got the blue stock, although you may be right, and for example, thinking that the market will go up, you probably need to adjust your entries, you need to adjust your stop losses, and I can see it can be quite frustrating, because a lot of people may say, okay, I was right on the market, I was right on the direction, I was right on the timing. I mean, they make the right decision to get in, they made the right timing to get in, but they got stopped out because their stop was too close. And I think usually a stop too close has to do with usually with volatility. I mean, they haven't accounted for it. And it also has also very important with entries, and of course, I mean, for more advanced uses such as volatility parity, position sizing, volatility weighting your positions. I mean, it can have a lot of implications, volatility across the spectrum of the decision making to make a strategy. So let's begin using the tools. Let's bring the basic concepts. How can we measure volatility? There are many ways to do that. So I'll let you one and see what are the problems with it, and then how we can improve them. So the first thing, let's look at basic concept. What is true range? Because a range of a bar can be its high or low, but what is true range? Why a range can be true? Okay, let's play a game for everyone that would like to answer in the chat box. So here we have a bar. It has the following prices. So high price 100, low price 90, open 92, close at 98. So its range is 10 points. pips, ticks, depending on which market it is, it doesn't really matter. So 100 minus 90, oh, the range is 10. Then we have another bar. It has the following prices: high 110, low 102, close 180, 18, and open 14. So please, in the chat box, write down to me what is the range of this bar. Yep, the range of this bar. Yep. No, so some said the range of this bar is 8. And I think that's the most common reply, but it's actually not correct. Let's see why. They say right 8 because 110 minus 2, 8, but that doesn't account for the gap, because if you see the first bar, the high was 100. If you see the second bar, the low is 102. So which means there is a 2-point gap between this bar's low within the previous bar's highs, which means, for example's sake, if you were long during the first bar and you held your position throughout the second one, and you would have pocketed the difference between 102 and 100. So these 2 points would have been in your pocket, because of the market would have gone up that direction. So the true range is actually the 1010 minus the previous bar's high, and well, the close, if you will, because if the market had closed at 98, you would have gotten all these differences as well. So it's 1010 minus 98. So this is the formula for true range. It's quite simple. I mean, it's standard textbook material. The difference between today's high minus today's low, and you can see the same calculation, whether it's standard calculation within your charting platforms. So there's nothing, and it's an ingenious way to actually calculate for gaps. All right, so this is a real life example. As you can see, bar 3, bar 2 had a gap. This is for euro, and the bar 1 was an inside day. So the inside day high is 1.0908 minus 1.0864. So it's an inside day, the same way you would calculate bar 2, bar 3, but bar 2 you would actually calculate it from so from the previous bar's close, which is 1.0706. And you can see this calculation right at the bottom. So the first bar is 44 ticks. The second bar is actually 202 ticks, because there is a huge gap. Probably a news item may have been. But you can see how much of a difference it can make in the calculation of the gap, in the calculation of the volatility. So this is how it looked like, the true range, if you were plotting it every day's bar. Every bar the volatility. So you can see obviously a wide range bars, large bars have big volatility, true range, and you can see how it measures up the daily calculation. Now, the difference here is, of course, range is the calculation of volatility on a daily basis. It doesn't show you what happens across time. Basically, it answers the question, how much is the volatility today? It doesn't tell you what's the average volatility over a period of time. So this brings us to the next concept, which is average true range. And average true range basically solves the problem of, answers a different question, if you will. So true range answers the question, what's the volatility today? Average true range answers the question, what has been the volatility in the past. For example, depending on the look back period, it may be 5, 10, 15, 20 days. Again, very simple. This is the formula. We all know it. Average true range, for example, for 10 bars meaning 2 weeks. You can have true range 1, 2, 3, 10 divided over 10, and then you get the calculation. So this is how it looks like. So on the top chart, you've got the the market. And the second panel, you've got average true range in bar format. And then you've, sorry, in average true range, you've got the, you've got true range. And at the bottom, you've got average true range. So you can see how it fluctuates. And it answers basically how much have been the volatility for the past 10 days. And you can see that the trend for volatility has been down, which means the market has been having less and less fluctuations. So, but the thing is, now, what does volatility, the average true range, have an issue with it? Because we mentioned the true range, the issue is that it doesn't show what happens through time. But the average true range, the issue you have here, it compares absolute points. So if a market is measured in ticks, pips, whatever is the underlying measure of value, the measure of price, it calculates that, but it's not comparable. For example, if you've got a high-priced item, like say the Dow Jones, index, because it's a much larger market in terms of absolute value, absolute price, it will give you a bigger value than if you're measuring something like a low price, like say for the example, the euro. But that doesn't mean that one is more volatile than the other. Right? It's just a function of the price, the absolute price. So look at this as an example. So this is the example of the euro. And right at the bottom, the average true range is 74 ticks. Now let's look at the market like the Dow. As you can see, it appears to have almost 3 times the volatility. Yeah? Twice the volatility actually. So does this mean that it is twice as volatile because it has twice the pips? No, it's just a function of the absolute price. So how can we solve that? The way to solve that is by the what we call the normalized average true range. And the normalized average true range is basically comparing apples to apples and oranges to oranges. So how can we do that? Right, normalized average true range. Average true range is basically we take the true range and divide it by the close. And why do we do that? In order to put these points, the absolute value, into context of the underlying market. So if one is fluctuating, say 100 points, but what is the absolute value that the market has? And if one is fluctuating 10 points, but what is the absolute value of that? So we divide the fluctuations by the absolute value to put it in context of that, and multiply it by 100 to put it as a percentage. So this is how it would look like. So Euro FX, here it would appear that the 74 ticks translate into 0.7% fluctuation. And so both numbers are correct, but they give different information. So 74 ticks would answer, say, for example, if you want to put your stop above further away than its average fluctuations would be 74 ticks, and say, okay, I want to be putting it, say, 1.5 times its volatility. So that would be, say, roughly 110 ticks. So if you want to put it at 110 ticks, or you could say, I want to be putting it at 1.5%. Obviously, the one is picks and ticks, 1 in percent, but the 1.5% is comparable across markets now, and of course across its history, because as a market is growing in the price, so for example, like the S&P 500, it will be increasing the absolute value of the average true range, but not necessarily its volatility. And same thing here. Look at the Dow. We mentioned that it's 159. But in percentage terms, its volatility is 0.79. So let's go to a previous chart. So this is 74 ticks, 0.70. And this is 159 ticks, but 0.79, which is basically the same. So again, so if you were to, in this particular example, place your stop away from the market based on volatility. And so we would definitely need to have it more than 0.8% away from the current price, because that's how much it fluctuates within the day on average for the past 14 days. And as you can see from the chart, it's the volatility is dynamic. You know, we go from more volatility to less volatility and so forth. So it's not a static number. So let's go into techniques. So we've seen the basics: true range, average true range, and normalized average true range. And this tell you what volatility is, but it doesn't tell you its direction and whether it's going up or going down, and more importantly, if it's high or low. Because one of the properties of volatility is that it is mean reverting, or say extreme seeking, which means that if you've got high volatility for some time, it's unsustainable, and you know that it will be reverting back to some kind of a mean, or going from one extreme to the next. So you do want to be knowing when volatility is at its extreme. And average true range or the normalized will not tell you this, but I've created the volatility valuation indicator just for this, to solve this issue. All right, so let's see first of all, what is the volatility, the trend of the volatility. Again, very simple way to see this. Now we've got a chart here, Dow Jones Transportation Average, and on the bottom panel, on the bottom panel, I've got the average true range, not normalized, the average true range, but you can use the normalized one as well. And then I've plotted the moving average. And what I do is I color code the average true range based on if it's above or below the moving average. If it's above the moving average, it means that volatility is rising. If it is below the moving average, I say that volatility is falling. Again, it's a very simple technique. You can get more fancy with it, but it won't make a difference. So if you want to answer how much is volatility on average volatility on a percentage, you will say it's 0.7% or 2% or 1.5%. You'll see the normalized average true range. But if you want to be saying what is direction, is it more or it's increasing or decreasing, plot a moving average on it, and then you will know whether you're getting increasingly more volatile or less volatile, because the number we examined before, of course, like I mentioned, it's not static, but it doesn't tell you if it's going up or down. So going forward, should I be expecting more or less? And this gives you an example. This gives you a definition whether it's falling or rising. So what's the tendency? So plot moving average, and I've got it color coded here. This is on TradingView. Feel free to email me so I can send you the indicator. So with this, you can see if it's falling or rising. But, and this brings me to the last part, and after that, I would like to be going into see some live examples. So feel free to write on the chat box any market that you would like me to see, and we'll be doing it, be seeing it live, live examples. I'll be sharing my through TradingView. So feel free to send me on the chat box any market that you would like me to see. So the last part we'll be seeing, and this is my indicator called Smart Volatility Valuation. And this is quite unique because this indicator, what it does, it answers the question not just if volatility is increasing or decreasing, but if it's high or low. So it actually provides evaluation it. So for example, if it's if it was momentum, it would be overbought or oversold. Obviously, this is not oversold or overbought, but if it's extremely high or extremely low, or if it's within high or low, or if it's within a normal range. So this is quite unique in my work, volatility valuation. It's very, very important, and I'll show you why. Okay, so this is how, in general, in principle, the oscillator it seems like an oscillator. I mean, it oscillates, not literally an oscillator, but it just oscillates around the mean value, and the mean value is 1. So volatility is considered to be extreme, at an extreme level, if it is around 1.3 or 1.4, and it is quite quiet, if you will. It's extreme, extremely quiet or extremely volatile if it's 0.6 or 0.7. So as you can see in this particular chart, which is I have it a bit on a long-term basis, so you can see the history of it. It will be doing, like I mentioned, we'll be doing live examples afterwards. You can see that when the market goes to these extremes, it doesn't stay for long, and that is quite good, because when we get an alert that the market has reached these extreme values, we know we should be acting. There are instances in history when the volatility goes past these alert points and can stay there for some time. For example, in the case of prolonged bear markets, but under normal circumstances, it usually reverts back to the mean quite quickly. And it's worth being alert to this event, to this condition, if you will. So let's look at the indicator and price trends. So this is how the volatility valuation indicator looks at the back. It's at the bottom panel, and up on the bottom, the upper panel is the price of gold. So look what happens when volatility is at an extreme, or it's extremely low or extremely high. When it is extremely high, usually, but not always, the market is by and large at the bottom. Now, I say usually because that's probably around, say, 70% of the cases, in most of the cases. But it can also be a top. But what happens in the vast majority of cases, the current trend stops, irrespective if volatility is on an up market or a down market, but it usually reverses. John Bollinger, my friend John Bollinger, has a very nice quote on volatility, and actually he was the one that got me thinking about this, and this particular quote, and perhaps I should have begun the presentation with this. He said, a high volatility, low volatility is the environment when trends are born. High volatility is where they go to die. And that's a very, very good quote. And that's the quote that got me thinking and said, how can I create an indicator that defines when volatility is high or low, hence the volatility valuation indicator. So let's see how trends are born and how die. So this is as you can see, the examples when volatility was high. This is the chart of gold. And of course, obviously, I've chosen a few examples who highlight this particular property of this indicator, but we can look, like I mentioned, on a live basis. Feel free to write on the chat box any market you would like, so we can immediately see that. So now this is the chart of the British pound. Again, high volatility usually goes with bottoms. Most of the times it goes with bottoms, but we will see example what goes with tops. The point I'm trying to make is, as John Bollinger said, high volatility is when trends die. Again, so here are some useful rules of interpretation. So indicator extreme values are trend change when trends die, or reversal, because you can have both, either a change or a reversal. Reversal means goes from up to down. A change means goes from up to sideways, or from down to sideways. Usually, but always, high volatility is at a bottom, and low volatility is at the top. Of course, I say usually, but it's always double check what the trend is. And these are warnings, not signals. These are the 3 main points to remember with the proper use of the volatility valuation indicator. So let's look at also some other rules of guidance, how to properly use this tool. First of all, always check what the chart is doing. do not automatically assume because high volatility it must be a bottom. For example, here's an example when extreme volatility is at a top, and right on the right side of it, or the second occurrence, you can see that extremely volatility can go at the bottom. The point, so high volatility, most of the cases, it goes with bottoms, but in general, in theory, it's agnostic. So always do check the chart. Don't assume it's a bottom because most of the times it does that. So what is the second point we'll be trying to make? Never forecast based on that. Because I've seen it many times when the market reverses, and sometimes it just changes. So be aware of that. But it can be very useful for example, for your stops to take profits, irrespective of whether it's going to be a trend change or a trend reversal. But don't automatically assume that the market will reverse, because it does on a number of times. For example, in this particular example, the indicator, the volatility valuation indicator gave a high reading, but the market did not reverse its trend. It changed. So you go, first of all, it happened during a top, not a bottom. And then the market changed the trend, which means it was going up until that point, and then it took a breather. So it was a change from up to sideways. It wasn't a reversal from up to down. So do not assume that it always will be working perfectly. It will be bottom and then will reverse. No, in real life, markets don't work like that. Again, indicators are not systems. So for example, all right, so this is a very good example when it doesn't work, and I'm trying to be completely transparent here and tell you and show you how it works in real life. Now, so in the indicator at the bottom panel, as you can see, the volatility, smart volatility valuation, the indicator crossed the extreme volatility zone, but it kept rising. So it kept rising and rising and rising. So the market kept dropping. So the volatility valuation, it's a free oscillating indicator, which means volatility can keep rising as the market, in this example, keep falling. So it's prudent not to be assuming, for example, having seen that the market is falling, volatility is on the rich side, on the expensive side, they say, all right, night has bottom. No, it's in my book, it's always a way to wait some kind of a reversal and small reversal in price and volatility. So do not automatically assume. So take a look, for example, at the vertical blue line, the left one. This is when the indicator entered the expensive, the high volatility, extreme volatility zone. But then it gave you another 2 bars up until it bottomed, but these were huge ones. So it wasn't a market timing indicator, but it can be used as a volatility filter for entries. For example, you can say, I do not want to be shorting when the volatility valuation indicator is in the extreme zone and you're short and bearish, or you can use it as an exit filter. So when volatility valuation is at an extreme zone, the market is falling and you're short, and because, so for example, if you were lucky enough to be in this market and you were shorting it, but you see that volatility valuation is at an extreme, that will be as a warning for you to bring your stops closer to the market, or if you're more risk averse, to close your position, because given that it is at an extreme level, it makes the probability of a bottom even more highly likely. So you can use it in this example as a warning tool for your exit positions. And so to recap, we talked about true range, the definition of true range. We talked about average true range, what is volatility on a bar to bar basis. Talked average true range, what's the volatility on a period of time. And then we talked about average true range on a normalized basis, how we can put volatility on a percentage basis. And then we talked about the volatility valuation, smart volatility valuation. So if there are any questions, feel free to write them in the chat box. And there is an attendance bonus for all those that managed to stay awake during the presentation. Um, as I mentioned in the beginning of the presentation, I wrote a paper, like I mentioned, in 2015, was awarded in 2022, was given 2 international awards, and also created some indicators. The MACDV, the MACDV indicator, which is a volatility normalized MACD, that helps to solve the 5 problems that the MACD has. So if you would like to receive the papers and also send you the indicators, which is that are currently placed in TradingView, stock charts, MetaStock, MT4, Optima, and other trading platforms, feel free to send, and also be holding some webinars as well. So feel free to contact me. These are your attendance bonuses. Now, if there are any questions, I will be more than happy to take them in the chat box. And if not, I can go straight to perhaps seeing a few examples, live examples, because I think it's, let me see, where is the, yep, there you go. Right, so this is an example of the euro. Right, so this is the example of euro. And what I'll be scrolling through to see scrolling through the charts, you see what happens when volatility valuation is low. Here again, low, it started increasing and created this, the last up leg. Here it was high. At this point it was high. So it was time to, like a warning sign to book profits because the market went nowhere for about a month. Again, short-term, it gave you a top here. Volatility valuation signaled a bottom here. Volatility valuation signaled a bottom here. So when it's an extreme here, you can see volatility valuation here signaled a bottom. Again, here it signaled a top. Again, here it signaled a bottom. As you can see, so it is a very useful indicator to show you that, to give you a warning that the short-term trend might be changing. This is one example here, of course, volatility valuation here. It signaled that it was at an extreme. Again, it helps you a lot both for your entries and your exits. Here, volatility valuation, it signaled a bottom, sorry, a top. Here, the volatility valuation is showing that a new trend will be beginning soon. As you can see, you had this down leg. Again, volatility valuation here gave you the bottom. Volatility valuation here was all this period was giving you a warning, a heads up that a euro would be topping here. Persistently high volatility. Again, you can see here high volatility signaled here at top, high volatility here again in this area it signaled the bottom. You can see it's not, I wouldn't be using it for a market timing tool, although sometimes I must admit it happens very close to the turning point, but by and large I don't use it like that. Again, high volatility here at bottom, high volatility here for the top, high volatility here for the bottom, high volatility here for the bottom. Let me scroll the chart a bit. High volatility here during this period, this short-term bottom, so the short-term top. Again, low volatility. And the interesting part is that when you even, not just like the extreme of the high volatility, for example, here, high volatility on the left, as you can see, it signals the bottom. But I use it, of course, in conjunction with other tools, especially the MACDV, because I use that as a setup tool, which basically as a warning that something may be changing. So I think it's a very useful setup tool, high volatility, and of course, the low volatility readings as well. And with that, if there are no more questions, I would like to thank you all for for your attendance. Feel free to contact me for further information and also the attendance bonuses. And if there are no more questions, I would like to thank you and have a lovely evening. And please do take into account volatility because it's a factor that it's definitely deserves your attention. Thank you very much.